Why emerging markets are such a big deal, and what the heck they are. How emotional investing may be a good thing, and basic retirement information you may be getting wrong. This is Your Money, Your Wealth. Today on Your Money, Your Wealth, investor optimism is at a 17-year high with the Trump effect in emerging markets, but what does that really mean? Joe explains how being emotionally invested in your portfolio may serve you better in the long run, and 6 basic retirement questions most Americans can't get right. Now, here are Joe Anderson, CFP, and Big Al Clopine, CPA.
Yes, we are back again. Thanks a lot for checking us out. Hey, investor optimism, highest since the year 2000.
Oh, really?
17 years, Alan.
Okay, that's interesting. And of course, we know that was right before the dot-com bust.
2000 through 2002 was the worst bear market we saw since the Great Depression.
Right.
And then we saw 2008.
And that was even worse.
So before that, so 2000, right? Everyone's super happy.
Yeah, that's when it was the new economy
in the U.S.
and
market.
The old metrics don't work anymore. Warren Buffett's all washed up. He doesn't know how the new market works, new economy works.
Yeah, because he didn't really like the tech bubble.
Right. Turned out he was right.
Yeah. So 2000 through 2010, the U.S. markets, if you look at the S&P 500, was down around 9%.
Yeah, right.
So you started with $1 million. 10 years later, if you were fully invested for that 10-year period, you had $900,000 if you were fully invested in the U.S. market in that 10-year period.
10 years, S&P 500.
So they called it the lost decade.
Right, which, I mean, that would be a normal, that'd be kind of a cool term to call it because that's what it seemed like, right?
Right. So right before the lost decade, that's when optimism was at its best.
Got it.
And so we are once again...
Are you predicting another lost decade?
No, I'm not. I'm not predicting anything at all. But
okay.
I think I talked about this a little bit last week, is that there's a lot of overconfidence right now going on in the overall markets. And not necessarily the markets themselves, but people that are investing in the markets, just the average everyday Joe. And no pun intended there, but because, well, let's take a look at what the market did for the quarter.
Last quarter, huh?
All right, so
Q1 2017.
2017. The U.S. stock market was up 5.74%. International developed stocks were up 6.8%.
Wow, okay.
Emerging markets were up 11.4%.
In one quarter.
In one quarter.
How about that?
1 quarter. And then global real estate was up 1.4. Speaking of best quarters, right? And I think when we had this email question last week about an individual that was trying to get 40% rates of return.
Yeah.
And unfortunately, that's very difficult to do, 40%. Yeah. But I guess if you invest in emerging market stocks and they continue to do 11% per quarter,
you're over 40%.
You're over 40%. And I think that's exactly what I said. I said, if you want a really high-octane portfolio, here's what you do, right? You invest in emerging markets, value, small value.
Yeah, you're right about that. And over the long term, it will likely, not guaranteed, but it'll likely outperform other asset classes. And by long term, I mean a decade. I mean, this could take years for this to kind of show. But Joe, I mean, the problem with that is you could lose 50%, 70% in 1 year with an asset class like that.
So if you break it down, because the highest, right, was back in 2009, the best quarter ever for emerging markets were back in 2009. They were up 34.7% in a quarter.
In a quarter, okay.
But also the worst quarter was Q4 of 2008.
Okay.
Was down 27.6%.
I see.
In the quarter.
In the quarter, yeah. These are big numbers for
huge swings.
For a 3-month period.
Huge swings. And so if you break down emerging markets, if you really want to get technical here, Al, because I know you're really into these numbers.
Well, I am an accountant.
Well, emerging markets is about 11% of the global market capitalization. 11%.
Really? I wouldn't have even thought it was that high.
5.1 trillion.
Okay.
All right. And so if you look at value stocks in emerging markets, was up 10%. Large cap growth was up 11%, but small was up 13%.
Okay.
Right? So that kind of carried the flag there for emerging markets. Do you think, how many people do you think know what an emerging market is?
Probably not too many, Joe.
Well, can you name a couple emerging markets?
Yeah, I would say India, Brazil, China, to name a few.
India, Poland, Chile, Korea, Mexico, Taiwan, China, Brazil, Turkey, Malaysia, Thailand, Philippines, Czech Republic, things like that. Egypt, right. South Africa,
Okay.
Greece, Russia.
Yeah.
So those are all emerging markets. I would think
Yeah.
Russia would be a developed country, but it's not. It's an emerging.
Well, because you know why? It's because capitalism is new.
That's why you're here, buddy. Because they were what? Communists.
Yes, right. And that's a little different system.
Oh, this was something interesting. If you really want to get in the weeds here, guess what the top currency was performer over the dollar over the last quarter?
Over the dollar. Let's see.
Yeah, you're not going to guess it. It's our neighbor, Mexico.
Oh, okay.
Right?
I wouldn't have guessed that. Yeah.
The peso was up.
Yeah.
So all in all, it was a really good quarter. So again, the U.S. stock market was up about 6%. Okay, so that's for the quarter.
That's really good. Yeah.
And we always talk about global diversification. And I think there's a lot of home bias when it comes to someone constructing their overall portfolios.
Yeah, because we live in America. We know more about America than other countries.
Sure, but I think you're missing out on a lot of return by having a globally diversified portfolio, just as this last quarter shows us. Right. As you know, international stocks were up almost 7%, and again, emerging markets were up about 11.5%. So a lot of things happened over the quarter. You know, we had this Trump effect. You know, Donald Trump was now our new president. But everyone was still talking about the U.S., not necessarily what's going on around the globe. So,
true. Yeah, good point. And I think going back to your story about the last decade, you look at international stocks and emerging markets over that same 10-year period, they did rather well. And if you had a globally diversified portfolio from 2000 to 2010, maybe 60% in stocks, you probably got 5 or 6% compounded, which is a lot better than losing 10%.
Right. And then so I guess going back to this optimism in the overall markets, if we just take a look at over the past year, if you take a look at the total U.S. stock market for the past year, it's up 18%. Large cap is up 17%. Large cap value is up 19%. Large cap growth up 15%. Small cap is up 26%. Small cap value is up 29%.
29, yeah.
I mean, so these are huge returns that we're seeing over the past year.
Right.
So I'm not saying that we're going to see another lost decade, but you have to take a look at your overall portfolio, I think, and it might be a good time to kind of say, all right, well, here, how much risk am I actually taking on in the overall portfolio? Because no one loves diversification when the market goes up. Right.
You don't want to be in bonds when the market's going up.
Of course, I hate bonds. Why would I ever want to invest in bonds? Look at this big track record.
Right.
But how many of you would have been happy to have, a good chunk of your money in bonds, when the market dropped 20, 30, 40%?
Right.
So you have to take a look at kind of how the market works, is that it goes down a lot quicker than it goes up in a sense of getting your money back. I mean, you see gyrations, right? Just like emerging markets was down 27% in a quarter. Now, 2 quarters later, it was up 36%. And you would think, all right, well, no big deal. I'd probably have my money back. Well, it doesn't necessarily work that way, because if you lose 50% of your money, you need 100% rate of return.
Yeah, and that's hard to grasp until you think of the math. You got 100,000, it goes down 50%, so now you got 50,000. To get back to 100, you got to get 100%. You got to double your money from 50,000 back to 100.
Right. And then so the lower volatility that you have, the recovery time is that much shorter. So that's a 50% drop. Let's say if you go to a 30% drop. So now I lost 30% of the overall portfolio because I'm 100% stocks. Well, all right. Well, that's great. I don't need a 60% rate of return if I lost 30. Now I need a 44% rate of return. And so if you lose 10%, you probably need 12% to get back to even. So when you approach retirement, you want to take a look at the volatility of the overall portfolio. Because here's what I can show you, Al. I can say, all right, I have 2 portfolios that you can invest in, Portfolio A and Portfolio B. Right? And what do you think most people want to know about Portfolio A and Portfolio B?
Well, they want to know what's the rate of return.
Absolutely, right? So let's say Portfolio A over the last 10 years did 8%, Portfolio B's done 6%.
I want A.
You want A. Of course you want A, but you're missing
it's a better one.
That's only half the story, right?
Right.
It's only half the story, because there's risk associated with getting that 8%. So you have to take a look at how much risk that you're taking to get the 8% versus how much risk that you're taking to get the 6%. If you're taking half the risk to get the 6% rate of return. Now, which is a more optimal portfolio to own?
Yeah, especially when it's your retirement nest egg.
Yeah, of course, if you're approaching retirement. But you have to take a look at the risk and return relationship, because a lot of portfolios are not necessarily equipped or efficient, right? They're taking on way too much risk. And for that risk, they should be achieving a lot higher expected return, but they're not because of how that portfolio is constructed.
Investor optimism reached a 17-year high with the Trump effect, but who knows what's ahead? Larry Swedrow's book, Playing the Winner's Game, Think, Act, and Invest Like Warren Buffett, offers bedrock investing principles that can help you profit in today's shaky markets. And right now, it's available for free to Your Money, Your Wealth listeners. Click special offer at yourmoneyyourwealth.com to get your free copy. Learn how to think like Warren Buffett and build a well-designed portfolio based on solid evidence and your highest interests. Playing the Winner's Game by Larry Swedrow, with a foreword by Joe Anderson CFP and Big Al Clopine CPA. Click special offer at yourmoneyyourwealth.com to get your free copy.
Talking about investor optimism, it's at its highest since 2000, which is good. I like optimism.
Yeah, I do too. I'm an optimistic person myself.
Yeah, index gained 30 points this quarter to 126. The highest was 130. That was back in November of 2000, right towards the end of the dot-com bust. I'm not saying that we're going to receive another dot-com bust, but more information is better when you make investment decisions.
Sure, right.
And let's say this, Al. We see people that are very emotional towards their investments. And then you see some people that are not very emotional towards their investments. And what would you say would be better?
Well, from history, the ones that aren't emotional actually do better because they let the portfolios do what they're supposed to do. The emotions kind of force you to do. They tell you to do the wrong things.
But I don't actually believe that is true.
Okay, what do you believe?
Because if you take a look at Dalbar studies, right? So let's say I'm not emotional at all towards my investments, but the market produces X and I'm going to produce Y, which is always going to be significantly less than the market.
Right.
Would you agree with that statement?
Yes, I do.
Right? So if I'm not emotional towards my investments, so what am I doing with my investments when the market goes up or down? I'm buying and selling at the wrong time.
Well, I think that's when you are emotional.
Okay, all right. So how about more personal? Maybe I used the wrong word. Because we ran into an individual, and we run into a lot of individuals that have individual stocks, and they have a very personal relationship with that individual stock. Would you agree with that?
Yes, I sure do.
Right? And so if you ask that person, hey, you should probably sell this stock, what would they usually tell us?
Almost always no. This has been such a great stock for me.
So this individual bought the stock, I don't know, probably for a couple $100,000, what, maybe 20 years ago.
Yeah, and it's done well.
And it's worth like almost $3 million
it's
today.
in the millions, right?
Yeah. And you probably have a device that you use that you call people with.
The company starts with the letter A.
Yeah, and it has a little bite out of the fruit.
Got it. So
Right?
you're all right. I'm with you now.
So, let's say if someone works for their overall organization, right, we see that highly concentrated positions in their company that they work for.
Right.
You see highly concentrated positions in maybe the area that they live in, such as, we live here in San Diego. We see a lot of individuals that had large concentration in Qualcomm stock. If you go to Atlanta, you see a lot of people with large concentrations of Coca-Cola. And so there's this personal emotional relationship with that particular investment. And I don't think that that's a bad thing if it wasn't a concentrated position. If you talk about an index fund, a Russell 2000. Woo! I'm really, emotionally engaged with the Russell 2000. No, you're not. You're like, what the hell's a Russell 2000? Or the S&P 500. People don't really know what stocks are in the S&P 500.
Sure.
Or the Dow Jones, right? You hear these other terminology, and it's like, okay, well, no, the S&P is going down, so I'm going to sell it. But if I have Apple, and I love Apple, and if it goes down, am I going to sell it?
No.
Probably not.
No, because you have a personal attachment to it.
Yeah, exactly. Mm-hmm. And so going back to Dr. Crosby, Daniel Crosby, he's a behavioral finance PhD, and he was saying, and I have two sides to this, right? If you come up with investments and maybe you create like an exchange-traded fund or a mutual fund that someone has passion around, feeding the homeless, let's say,
Okay.
Right. So then you can purchase all the stocks that companies that would, be involved in doing something like this. The freight companies, the farmland, or, the list goes on and on of how, food gets to someone's table.
Sure.
You can kind of back that up. And then, or women's rights, or whatever you're passionate about. And all of a sudden they had an investment with that, that was diversified, if you will. Do you think people would say, all right, well, here, I can sell my investments that is engaged in women's rights or feeding the homeless or whatever passion that you have versus the Russell 2000?
Yeah, no, they'd stick with what they're passionate about.
Sure, right? So I think there's got to be a better way to educate individuals on what they're actually holding to get maybe more of a personal tie, because we know if someone has a diversified portfolio and they hold it for the long term, they're going to be significantly better off unless they have, that emotion, the fear, and the greed come into play.
Yeah, I think that's right. And I think it's certainly we all know that if you buy into a stock or a company and it does rather well, you will beat the market, right? But the probabilities of that it's difficult. It's difficult to find that next Apple stock. That's the problem, right? And especially, Joe, I would say this. When you get to retirement age, and let's just say you made all your money in Apple stock, great. But now at this point, do you want to still have your whole retirement hinged on a company that who knows what Apple's going to be doing 30 years from now?
But if I love Apple, I just ignored you.
Yeah, I know, right? And,
you know what I mean? It's like, I don't care what you're saying. I probably heard it, but you don't know what the hell you're talking about.
Yeah.
You're a CPA.
Yeah.
Because
I know.
we get that's such a tight personal relationship with it.
You're right about that.
Then you hear the other advisors and brokers and things like, oh, well, Enron. I mean, how many times have you heard that stupid analogy?
Yeah, all the time.
Oh, my God.
And actually, I would never predict that Apple's going to go away, but can it still keep performing at that same level for the next several decades? I don't know, right?
Yeah, I don't know either. I guess that's the issue,
right?
Is that, all right, well, I don't know if one particular company is going to continue to perform at the level that they perform at,
right?
But I could probably have a higher probability guess to say, well, 500 big, large, strong companies in the U.S. or internationally or even emerging markets as a collective whole,
right?
Do I think that those companies are going to continue to perform? I think we both agree, yes, we would have a stronger probability of that.
Yeah, I think that's the key word, probabilities. And you know what? When you're younger and you want to take some of your assets and go for a few stocks and try to make some money, I mean, if you want to, go for it. But at least in my view, you get into your 50s and 60s and you built a certain nest egg, you want to increase your probability that it's going to last over time.
Yeah, it's because we're twice as fearful to lose money than we are to gain money.
Right.
But the problem is right now is that we're so optimistic of what's going to happen in the market because we've had such a huge bull run since 2009.
Yeah, so we get this overconfidence bias, right? And which isn't necessarily our friend. And sometimes, not always, sometimes we've seen where a young person makes a lot of money in a stock and they think, well, this is easy, and they're overconfident, and then after that, they don't do so well.
Right.
It almost would have been better had they lost money up front, and then it's like, okay, there's got to be a better way to do this.
Exactly, right. Because the best investment you can possibly own is what? One individual stock.
Right.
The worst investment you can possibly own is one individual stock.
Right.
So the higher probability of success is really what we're all about. We want to keep it boring, right? But we try to, keep it light.
Sure.
But your investment should be boring,
Yeah, I think so too. I mean, I got an article here. This is Leon Cooperman. He's a billionaire hedge fund manager, and he's defending his industry, which hedge funds have not done very well over the last several years. And he's saying that passive management is not how famed investors have built their fortunes. And I would agree with that.
100%.
I mean, if you aspire to be a billionaire, you got to take all kinds of crazy risks. Yeah. Now, for the rest of us that want more predictability, I would take this statement and throw it in the garbage can. I think we want to make sure that our nest egg is going to be there for us.
Right. True wealth is built by owning, and owning could be a fractional ownership of a company stock. But yeah, if you want to be a billionaire, the billionaires, they own their own companies, right? And then they own multiple companies.
And then they're successful, and then they start investing as an angel investor or a venture capitalist.
Got it.
And so it's
Shark Tank.
Very risky, but some of those hit, and they keep parlaying their future.
Right, because it's like, okay, well, here, that's a very risky proposition you have. I want 70% of your company. So if it hits, I'm going to bank.
Yes,
If it doesn't, well, I'm hedging my bets.
Right.
Stress test your investments. You may be taking more risk than you realize. Find out your risk number with our risk factor tool at yourmoneyyourwealth.com. Make sure your portfolio aligns with your investment goals and expectations. Identify how much risk is acceptable to you and compare it with the amount of risk you're currently taking in your portfolio. Together, we can take the guesswork out of your financial future. To find your risk number, just visit yourmoneyyourwealth.com.
I was, just for fun, I put in our podcast, on our show, Your Money, Your Wealth, and then the word podcast. I wanted to see if it appeared on anything. And you get a few, financial planning, top 10. We haven't hit that yet, but
Bottom 10.
I did find. I found one that said top 120.
All right.
And we were in it.
Okay.
Yeah, so we're up and coming.
Hey, we are up and comers. Now we have to disclose exactly what was that list, and that means nothing about the performance of anything that we discuss.
Yeah,
and the list does not mean that Al and I know anything what we're talking about.
Yes, Danny Martin, compliance officer. We're trying to do this right.
Yeah, clean up your act there, Clopine.
So I have a quiz for you, Joe.
All right. Let's see if I can pass.
This is from the American College, and this is the Center for Retirement Income. And so there's 6 basic retirement questions, and most Americans cannot get these right. So let's see how you do. All right. If you had a well-diversified portfolio of 50% stocks and 50% bonds, that's worth $100,000.
Okay.
Okay? At retirement, based upon historical returns in the U.S., the most you could afford to withdraw each year is about X, plus inflation each year to have a 95% chance your assets will live for 30 years. And this is multiple choice. You got $100,000. Can you draw out $2,000, $4,000, $6,000, $8,000?
Well, you could pull out 2,000. You have probably 100% probability.
That would be real safe.
And then 4,000 is probably the correct answer.
Yeah,
a 4% distribution rate.
It is the correct answer. And of course, that 4% distribution rate rule, or 4% rule as they call it, that's been around for decades. And that's
Bill Bingen.
Yeah, it's not perfect. There's some people can do more, some people way less, depending upon your circumstances.
Your
but at least
age or portfolio.
Yeah, at least it gives you an idea. And Joe, it's interesting that a lot of the participants in this quiz thought that they could withdraw somewhere between 7 or 8% of their portfolio because the stock market has earned that or more. And the problem with that kind of thinking is the stock market does not go up in a straight line, right? That's one problem. The second problem is you got to keep some money in there for growth. Otherwise, you don't keep up with inflation. If the market earns 5 and you pull out 5, every single year you're taking a pay cut because goods and services are costing more.
I teach a lot of retirement planning courses, it's adult education. And every time I go through that 4% distribution rule, right?
Yeah.
And say you have $1 million, right? And then I ask, how much do you think that you can pull out of $1 million? Right. Because $1 million, that means you're rich.
Yeah, right.
That means you are 1%er.
Right.
And then it's like you get answers all over the board. $100,000, I don't know, at least 90, 80.
Right.
And then I say, you don't want to pull out any more than 40. 40's even pushing it.
Right.
What? You're kidding me.
Yeah, right.
You don't know what the hell you're talking
I could
about.
live off $100,000 a year. Stock markets earn 10%.
I got $1 million, Joe.
Right.
I'm going to live off $100,000 a year. All right, well then have a good 10 years.
Right.
You're done.
Maybe you get 15, but yeah, something like that. Here's the next one. 25% negative single year return. So your portfolio goes down 25%.
Okay.
In your retirement portfolio would have the biggest impact on long-term retirement security if it occurs 15 years prior to retirement, at retirement, 15 years after retirement begins, or the timing doesn't matter.
The timing absolutely does matter.
Yes.
And it would be right at retirement.
You bet. Unfortunately, I guess there's a bit of luck involved. If you retire and the market goes down 50, like let's say you retired in 2008, the market went down 50%-ish over 18-month period, then all of a sudden you're in a kind of a tough spot. And of course, that's why we talk on this show all the time about you want to have growth in your retirement portfolio, but you want to have a lot of safety because markets do correct, and sometimes it's rather violent and it's quick.
Right. If you're pulling money out, so again, we used this earlier in the show. If you lose 50% of your assets, and I hate using that because it's like, what's the odds of someone losing 50% unless they are in one individual security? If you're in a globally diversified portfolio,
it's very unlikely.
It's very, very unlikely to lose 50% because you have some bonds, you have some stocks, international, and so on. And, the whole fear selling drives me nuts too. When you hear some of these other radio shows and podcasts, they always go back to 2008 losing 50%. So no offense to you, Al, since you just used that reference. But,
yes.
But, right, if you lose 50%, you need a 100% rate of return.
Yeah, right.
But if you're pulling money out, you're going to need a lot more than that because if you're pulling the 4% out, now you're down 54%.
Right. That's right. Yeah. So, yeah, that's, and so sequence of returns is what we call this risk. And so make sure if you're retiring, you have a portfolio that, has some growth in it, but has a lot of safety in it so that you can weather these storms. Here's this question. This is a great question, and you're going to have to think about it a little bit. So I'll say it, and then I'll come back to it. So which of the following strategies is least likely to improve retirement security? So least likely.
One more time? Sorry. I wasn't paying attention.
Which
forgot you were giving me a quiz.
Yeah, right. Which of the following strategies is least likely to improve retirement security?
Okay.
So there's three things that can improve your retirement, but one of these does a worse job.
One of these kids is doing
not
his
as
own
good as
thing.
the other. Now, here's the first one. Saving an additional 3% of salary in 5 years prior to retirement.
Okay.
Obviously, it's going to help.
Sure.
Right? Or deferring social
Who's taking the quiz, Clopine?
You.
Okay. All right.
Yeah, you're taking
Stop
it.
answering.
Yeah. No, I'm just explain it to you because I know you'll say, read it again. The second one is deferring Social Security benefits for 2 years longer than originally planned, or working for 2 more years past the planned retirement date. So one of these is not as effective. Saving 3%, extra 3% of your salary for 5 years prior to retirement, deferring Social Security benefits for 2 years, or working 2 years longer. Or the fourth one is don't know.
Well, let's map this out.
Okay.
All right. So let's say I'm saving money. I'm not sure how much money that I'm saving or how much money that I have.
Yes.
But if I save an additional 3% for 5 years prior to my retirement date, then I retire and I start taking distributions.
Right.
That's one. But then the second one is that I still have this retirement date, but now I'm not going to retire on that date, but I didn't save that 3%, so I'm going to push out my social, or I'm going to wait to take my Social Security.
Yeah, for a couple of years.
For a couple of years. So it depends on what is it full retirement age? Because at full retirement age, each year that you wait, then you get an 8% delayed retirement credit.
Right.
So does the 2 years of 8% delayed retirement credit match the 3% savings for the first 5 years? Or the last one was you delay your retirement altogether. You're not going to save, but automatically doesn't that already include B? Because if I'm going to push my...
It could.
Or does it say I'm taking my Social Security?
These are all meant to be mutually exclusive. But I'll help you a little bit. So the 3% of salary, so that would be an extra 15% of salary that you saved, right? If you work 2 more years, you got 100% of salary for 2 years.
Right.
So the math works way better that way.
If I don't...
Right.
If I save, if I'm not taking money out.
Even if you don't save, you're not taking money out of your portfolio. Okay, and then the other one, working past Social Security, waiting on Social Security. Well, if it's at 8%, or even if it's before full retirement age, it's a 6.5% increase.
I'm going to say all of the above.
No, they all improve, but one is not as effective.
So, delaying your retirement.
No, it's the 3% salary because because
I'm delaying my retirement. I'm going to get both benefits.
I know, but the question is which is least likely. That's what you weren't listening to.
This is a stupid question.
I knew I was going to have to explain it about 10 times.
All right, if I delay my retirement, I'm not taking money from my portfolio. This is good. Yeah. And then I'm also increasing my Social Security by 8% per year, which is also good. I'm reducing my life expectancy by 2 years, which is also good. What else? How else can I'm still saving into my 401k for those 2 years.
Yeah.
That's got to add up better than me just increasing my savings for 5 years.
That's what I said.
Oh.
Yeah, let's see.
Oh, so I misunderstood what the hell
yeah,
you're
that's
talking
right.
about.
That's right.
Good thing I redeemed myself there.
You got the right answer. Just
Just
I mean,
the wrong
you had the
one.
right thinking.
Yes, that's my life.
Your logic was right, but you just have to listen to the
Oh,
question.
I got it. It's tough, Al,
I know,
sometimes. It's
yeah.
like you're an accountant,
'Cause
and
if
I'm
I-
listening, and it's
if
like
I-
it puts me to sleep.
Well,
You got to get that tax chat going.
I get that. I understand that. So a single person who's likely to live to age 90 is generally going to be better off claiming Social Security benefits at 62, 66, 70, or 75.
70. Don't wait until after 70. That's stupid.
Why not?
Because you don't get an increase in benefit.
You're leaving benefits on the table.
Yes, you are.
Right. Okay. That's right. This is another easy one. Converting a portion of traditional IRA to Roth IRA is a good idea if. Okay.
In the low tax bracket.
You with me so far?
Yes, I'm with you.
Okay. You have a big tax deduction, and your marginal tax rate is lower than normal. That sounds like a good one. Right?
Yeah, that's true.
All right. You have more taxable income than usual, and your marginal tax rate is higher.
That would be false.
Correct. The value of the assets in your IRA have remained the same for 10 years. That has nothing to do with anything.
It's just.
And then D is don't know.
Did the person that write this pass this stupid thing?
I don't know.
A.
I just know that not a lot of Americans passed it, and they don't really say how many they got right or wrong, but
We're blowing up the clock here, bud.
I know.
He doesn't care. He's the CPA.
I like the quiz.
When it comes to planning for retirement, what you have now versus what you actually need are two entirely different things. Do you know how much money you'll need in retirement? Do you have a plan to achieve your retirement goals? Visit yourmoneyyourwealth.com to sign up for your free financial assessment and find out if you're on the right track. There are so many things to think about: income, risk, asset allocation, inflation, taxes, Social Security, healthcare, Medicare, long-term care. The list goes on and on. Talk to a professional. Sign up for a free 2-meeting assessment with a certified financial planner at yourmoneyyourwealth.com. That's yourmoneyyourwealth.com, and click the free assessment button to find out if you're on track.
Did I tell you that I got interviewed recently for all my successes?
No, I hadn't heard about that.
Yes.
By who? Your mother?
No, it was my cousin. I was in the Annandale Gazette.
Oh, good.
Yes, I'm the most successful person she knows.
You got it.
Yeah,
Yep.
and there's 208 people.
This is in Minnesota?
Yeah.
Yeah, got it.
208 people population.
So, well, that's pretty good.
She's graduating.
You're in the top 0.5%.
She's like, you're the most successful person. I need to write a little thesis on you.
Right. Okay.
It's like, all right, honey.
Very good.
Yeah. So I talked about my career. Did you know my financial planning career started in low-income housing in Atlanta, Georgia?
No, I didn't know. I knew it was Atlanta, but I didn't know it was low-income housing.
Oh, yeah. I lived in low-income housing.
Yeah, I got it.
Yeah.
Because you don't make anything when you start.
Well, no, I wasn't even in the business. So
you had no money. You just got through college.
Yeah. I originally from Minnesota. And so for any of you that are from Minnesota or been to Minnesota, right, it's a great place to be from.
Got it.
Not necessarily live. So I
and
was
you know,
freezing my,
the good thing about that is you get those good Midwest values.
I do.
And people appreciate that.
Yes, they do.
We hear that every week, don't we?
Yeah.
Joe, you're a Midwesterner. I trust you.
That's right. So I was like, I got to get out of here. I got to get out of the cold.
Yeah.
So I moved to Florida, and I got my finance degree from the University of Florida. And I graduated, I don't even know, 1997, 1998. I forget what year it was. Something like that.
Yeah, okay.
Yeah. And so I was dating my college sweetheart, and she was the weather girl for University of Florida.
Oh, they had their own TV
they had their own
station?
TV station?
Got it.
Yeah.
Yeah, okay, good.
She was the weather girl.
And she would say, it might rain today.
Yeah, right.
It's Florida.
It's Florida. It's going to be a little bit muggy. So she was really good at her job.
Yeah, right.
And so I
Always
graduated a year before her, or not a year, a semester, right? And so she was from Florida. I'm from Minnesota. I'm like, well, I'm not going to move back to Minnesota. And she's like, well, let's move to Atlanta.
Okay.
Right? I was like, okay, let's move to Atlanta. So I went up there first, scoped the land.
Yeah.
And I don't have a job. I just got out of college. I was a bartender in college. I paid my way through college, basically.
That's a great story right there.
Yeah. And so, no student debt? Yeah, I had about maybe $10,000.
Okay, of debt, and paid that off right away.
Yeah, because when I left Minnesota, the folks were like, cut off. You should go to this nice state school.
Didn't your dad say, if you leave Minnesota, we're not paying a dime?
Yes, we're not paying a dime.
Yeah.
They wanted me to go to the Army, Navy, Air Force, whatever. I get these pamphlets all over the place.
Very disappointing.
Yes, I was.
Joe Anderson.
Yeah, because I was from a military family.
Right.
So I moved to Florida, right? Then I was living in Atlanta, and I could only afford, it was like $300, $400 a month, and I was in low-income housing. And I was the youngest person, probably by about 60 years. Right?
Got it. Okay.
Yeah, there was like cribbage that happened down in the lobby and everything else.
So you probably learned how to play bridge and that
was one of the favorites.
All that good stuff.
Yeah. So I was studying for my Series 7 right there in this 300 square foot apartment. I could open the door, open the fridge, flush the toilet, all laying in my bed.
That's a nice feature.
Yes.
Didn't have to move much.
So I was studying for the Series 7 right there. And so I went and probably knocked on every brokerage firm's door.
Right.
Right? Because I'm an up-and-comer.
Yeah, right.
I have a finance degree from
University of Florida.
Right. And I didn't even know what the hell I was getting myself into, to be honest with you. I just knew my dad broke his back working hard manual labor.
Right.
And I was like, I'm going to wear a suit.
I'm not doing that.
I'm not going to do that.
I want to do something where you wear a suit.
I want to wear a suit. I want to look good when I go to the office.
You could have been an accountant.
I could have.
Yeah.
I could have. That was a little bit too boring.
Yeah, that's
right. I wanted to
I could say you put you in a box. That wouldn't work.
Yeah. My first experience in this business was god awful. It was so bad.
What did you do?
Oh, I just sat in this black room and just picked up the phone and just
dialed people.
Yeah, bugged people all day long.
I got this great product for you.
Yeah. Yeah, I was like, I want to help people, and then all I'm doing is bugging people. It's like,
everyone's pissed at you.
Yeah, but I'm wearing a sharp suit.
I thought I was going to help people.
Yeah, it was like from Kohl's. It was
Sonny, why are you calling me again?
Yeah. Yep, I had probably a couple $100 in my name, right? I went to Kohl's, got myself a nice,
You wear the same suit every day?
$70 suit. Oh, yeah. 2 white shirts.
Yeah.
It was good times. It was good times.
I think when I started in the CPA world, I think I had 2 suits.
Did you?
Alternated every day.
Yeah.
And then that's when I had a better memory. And I can remember what suit I wore for what client. So I made sure I didn't
switch it up.
Yeah.
Switch it up.
Yeah, right.
Yeah. So my girlfriend moves to Atlanta, right, at the time. And then she was going to be an expiring actress.
Okay.
And so she goes on a couple auditions, and so now we're living together in this 200 square foot, right? If you want to,
right?
She's flushing a toilet. It's like right there. Right.
That's why you broke up.
It was close quarters, man. It was really close quarters. Yeah. Oh, it was awful. So we lasted maybe a month living together.
Right.
And so she's going on these auditions to be this model, right?
Yeah.
And then so she's like, well, I don't really know if I'd like Atlanta. And I was like, thank God. Because I hate this place. No offense to anyone that lives in Atlanta.
Because I've never been. I've heard good things about the downtown area.
Yeah, Buckhead, was really cool.
Yeah.
A lot of fun, a lot of bars, I guess.
Yeah, okay.
It was
you couldn't afford them.
Oh, yeah, if you could afford them. I got Schlitz. And I'm laying in my bed drinking Schlitz.
Schlitz in your bed.
Yes. Right. Yeah.
Then you wouldn't finish it. You'd drink the other half the next night.
Yeah, exactly. It was so gross. So she went on this audition. She's like, yeah, well, they told me to kind of hike up my skirt, and I was supposed to growl at this guy.
Really?
And I was like, was he wearing a shirt? What kind of audition was this? Well, no, it was kind of in his apartment. He had a studio. I was like, oh boy. Jeez. So yeah, she left to Atlanta. I moved back to Minnesota. Then I got a job with one of the largest financial planning firms in Minnesota, and then I was like, I got to get the hell out of here. And
how long were you in Minnesota after you?
I don't know. This story's getting really long. Holy God.
Yeah, we get a whole segment.
Yeah, right here. My life story, Joe Anderson. So, yeah, this is the paper, the dissertation that my little cousin wrote.
You just went through this.
Yeah, I just went through this.
Read what was the Gazette?
Yes, the Annandale Gazette. I don't know.
Gazette.
Whatever.
Look it up on the internet.
Yeah, we'll get it.
Get Joe Anderson's history.
Yeah, it's my little cousin. She's graduating high school, so
nice.
whatever.
Okay.
But yeah, I was in Minnesota for maybe a year. Then I got promoted to be a VP of one of the largest financial planning firms. And then I moved to Wisconsin, And then I realized about conflicts of interest
Right.
with a big, large, Fortune 50, Fortune 500. I don't know. It's
Yeah.
like Fortune 50 company.
Okay.
Everyone kind of knows their name. You probably have a credit card with their name on it, Mm-hmm. But it was a financial advisor unit of that company.
Yes, got it.
And I was like, I got to get the hell out of here.
It didn't kind of jive with
No,
your morals.
I mean, I was young. I was making good money, but it was like I just had to, recruit and teach these other guys to sell their stuff.
Right.
And so I said, enough of this.
Yeah.
It's time to dip into the email bag with financial questions courtesy of Advisor Insights from Investopedia and you, the Your Money, Your Wealth listeners. Joe and Big Al are always willing to answer your money questions. Email info@purefinancial.com, or you can send your questions directly to joe.anderson@purefinancial.com or ellen.clopine@purefinancial.com.
Couple good ones here today.
All right.
So let's see here. How about this one? Can I gift my entire Roth IRA account to a grandchild, enroll all of the tax-free accumulation over to them? Or would I have to physically make qualifying and or basis withdrawals to set up a new Roth account in the grandchild's name?
Oh, that's interesting. Well, you don't want to do that because, well, first of all, you cannot gift a Roth IRA because it's in the family of individual retirement accounts. A Roth is an individual retirement account that actually has a tax-free feature. So it's your account. You can't give it to anybody. Actually, the best thing to do in this case is to have the grandchild be the beneficiary, so that when you do pass away, the grandchild takes over your position in the Roth, and it's still tax-free to him or her. That's the way to go.
Right, because there is no required minimum distribution in Roth IRAs. So if you're thinking, hey, I have this Roth IRA, want to give the account to my grandchild, well, unless he's looking to give him cash now, but it looks like he wants to take distributions and setting up a Roth IRA account for his grandchild.
Right. And
It will be the grandchild's at one point, like Al said. You named him or her the beneficiary of the account. And so let's say you have another 20 years of life. You keep on, that money's going to continue to compound tax-free. You don't have to pull that money out. You name the grandchild the beneficiary of that account, and then the grandchild would be the beneficial owner or the inheritor of that account. So it's called an inherited IRA. Maybe you've heard of the stretch IRA. And so what that does is it allows now, so it would still stay in that person's name, whatever his name is, for the benefit of the grandchild. And then that grandchild then will have to take distributions out of that Roth IRA. Even though there's not a required minimum distribution for the account holder, there would be a required minimum distribution for the beneficiary.
Yeah.
Even though they're the beneficial owner, but the deceased is still the owner of the account.
Yeah, and I think that's a lot of people don't really realize that. With that Roth IRA, if it's your own Roth, or if your spouse dies and you put it in your name, you don't have to take the distributions. You can let it grow your whole life. But once the non-spouse beneficiary gets it, you have to take required distributions every year, regardless of your age. You could be under 10 years of age and still have to take a required distribution. Of course, it's based upon your life expectancy, so the younger you are, the less it is. So now,
it's a fraction of a percent.
Right. So if you want to get this to the grandchild, clearly you set up the beneficiary statement for the grandchild. If you want to get money to the grandchild and you don't have any other sources, then you can pull it out of the Roth and give it to the child, let's say for college or something like that. But there's really no way to put it into the grandchild's name while you're living.
Another quick note here, too. You need earned income to create a Roth IRA.
Sure.
So the grandchild would need to be working. W-2 wage, 1099, pay Social Security tax, up to $5,500. Then you could do a full contribution to the grandchild. So if the grandchild's working, but there's all sorts of kind of funny webs in this question, because it's like, well, hopefully if he's given this money to the grandchild, you would think he's got other assets or she's got other assets,
Sure.
right?
Right.
So it sounds like, well, do I have to take these tax-free withdrawals from my Roth to fund another Roth? So he's thinking like it has to go to Roth.
Yeah,
for the grandchild.
Yeah.
No. If the grandchild has earned income, keep your Roth in the Roth. And then let's say he's got a paper route or something like that, or she does, then that grandparent could contribute $5,500 into a Roth IRA. He could or she could establish, the grandparent could establish the grandchild a Roth account, and fund it for the grandchild, but the grandchild would need earned income. That's the caveat.
Yeah, they would, and it's a dollar for dollar. So you can fund it up to $5,500, but the grandchild has to have $5,500 of earned income. If the grandchild just has $1,000, then that's the most you can put into a Roth for that year.
So I guess for the holidays coming up or 4th of July this summer, those are good gifts to give to grandchildren.
Yeah, wonderful gifts.
So if they don't have a Roth IRA, and if they're working over the summer, maybe they're in school, maybe they're even in college. Most college kids have some sort of part-time job. Well, I don't know. It seemed like a full-time job. Well, maybe not. I don't know. I guess they don't.
Right.
Whatever.
Yeah.
But if they have any type of employment, you can establish a Roth IRA for them, and you can fund it. And then that would grow tax-free for the grandchild's life. It's a huge deal. It's a great strategy for a lot of you that are listening. You can fund kids, grandkids, nieces, nephews, friends, family, whatever. As long as that person, the IRS doesn't care where the money comes from.
Right.
Right, as long as they have earned income. They earn $5,500, they spend every last dime of it on comic books. All right, well, you can still put the $5,500 in to their account from your checking account. But I guess if they're spending $5,500 on comic books,
may not be the best.
Yeah.
So here's something, Joe. Though,
right.
let's say that this grandparent does this and starts funding the grandchild's Roth with their own money because the grandchild has earned income. Great. So now, 10 years, 20 years, whatever, the grandparent passes away. Now the grandchild inherits the Roth. The tendency probably is, well, I already got a Roth. Let me put grandma's or grandpa's money into my Roth because that would simplification, right? But you can't do that.
Right. You got to be very careful with that. We've seen this quite often because with any other asset, let's say I inherit an IRA, a brokerage account, and a house, right? So grandpa died, grandma died. They left me a small IRA. They had some stocks in a brokerage account in their primary residence, and I was the beneficiary of all three of those assets. So myself, I have a brokerage account, I have an IRA, and I also have a Roth IRA, right? And so you would say, okay, well, let's distribute these assets. So let's sell the house. Okay, house, cash. What do I do with that cash? I put it into my brokerage account and I invest in my mutual funds, right? Okay, so they have a brokerage account. You know what? Let's just take those stocks that they already had. Let's just transfer those into my brokerage account. Everything's great. I'm consolidating and keeping this clean. Oh, and then they got this IRA. Sounds great. Let's let's take the IRA and move it right into my IRA.
Right.
That's where it blows up. You cannot do that. It's an individual retirement account, and the reason why you can't do that is the IRS wants their taxes. They either want it while you're alive, they're going to force the money out once you turn 70 and a half, and if you pass away with it, they still want to get their taxes because it's a tax-deferred account.
Right.
And let's say if I'm 40 years old and grandma dies and I put that into my IRA, well, I have 31 years, basically, to let all of that money still continue to grow tax-deferred until I turn 70 and a half.
Right.
They're not liking that, so they have to keep it in that decedent's name to take those distributions out on the non-spouse beneficiary.
It's a good point. I mean, think about it. So the grandparent is on a regular IRA or 401k, forced to take the money out at 70 and a half, and all of a sudden they pass away, goes to grandchild who's 10 years old. They'd have to wait another 60 years to get tax money. Well, they don't allow that.
Right.
So they want that 10-year-old to start taking distributions because grandma or grandpa was already taking distributions.
Exactly. Or even if they passed prior to their distribution date. It doesn't matter.
Right. They still want the money.
Right.
Yeah.
And so then it's based on that grandchild's life expectancy. So if it's a 10-year-old, I guess the parents are actually going to be taking those distributions for that 10-year-old.
Get social with Your Money, Your Wealth and Pure Financial Advisors. Follow us on Twitter at YMYW Show. To connect with us on Facebook, LinkedIn, YouTube, and Google+, just search for Pure Financial Advisors.
Got a few more emails, Alan.
Okay.
And then we'll pack this pony up and get the hell out of here.
Okay.
I bought a stock in 2013. It is nothing but a total loser. It's down 70%, and I see no solution other than to sell it for income tax purposes and deduct my losses.
Okay.
I bought it for $100,000, and it's now worth $35,000.
Okay.
Is selling a good idea?
Well, certainly. Now, a couple things. From a tax standpoint, yes, because you would generate a $65,000 capital loss. You can use that loss against any other capital gains. Hopefully, you bought a couple stocks that went up. And if you want to sell some of those, that would net against those gains dollar for dollar. If you don't have any other gains, then you get to take $3,000 per year, it carries forward the rest of your life, and when you do eventually have a stock sale gain or mutual fund sale gain, you can use it against that. But I think from an investment standpoint, I think you got to sit there and say, would I buy this stock today for $35? And if the answer is no, you should sell it. And then, of course, then you could take it another layer is, do you really want to be investing in individual stocks? And we talked about this in the first hour. It's, individual stocks, you certainly can make the most money if you hit it right, but you also have the most risk. And here's an example of the risk part. So we are big believers in, as Joe sometimes says, kind of a boring approach to investment that has higher probabilities, where you probably won't go down 70%.
You know why he let this thing go down 70%?
Because he was waiting to get his money back.
It's called anchoring.
Anchoring, yes.
Anchoring.
Yeah.
He anchored on his price that he bought it.
Yes. Yeah.
Right? So he was down 10%. He's like, ooh.
I want to wait till it gets back.
It's going to get back up. Then I'm going to sell it. Oh,
Yeah.
down 20%. No, I'm going to wait because I know this thing's going to go back up. Now it's up 30%, 40%, 50%, 60%, because people anchor on that stupid price.
Right.
And it's like, there's no way I'm going to sell this thing until it comes back. And then he finally writes into Investopedia and says, all right, do I write this thing off as a tax loss?
So it is a tax loss. That does help. But would you buy that stock today at $35,000 worth? And if so,
Right. Would you buy that stock price today? If
Yeah.
you had an extra $100,000, would you put it on that stock?
yeah, if the answer is yes, well, maybe
Hold on.
hold on. Why not?
If the answer is no, well, you answered your question. Okay, let's see. Well, there's a.
Got another good one?
Yeah, I think so. No, this might last us. Here's an interesting one.
Okay.
Well, there's two questions, and the first one's quick and easy. Second one is common mistakes that maybe some of, or misunderstandings that most of you might have. So let me go to the first one first. I understand that IRAs do not receive a basis step up upon death, but rather the beneficiary will pay ordinary income tax on the distributions at their rate.
Okay.
My question, therefore, is, what section of the code says this? I've already looked in 1014, and I'm basically out of ideas.
What code section says that?
It's publication 590.
Yeah, that's true. That's the one on IRAs. I don't know what the code section would be. I don't know why you'd really care that much about it.
He
but
doesn't believe whoever told him.
Apparently not. He wants to see it
He's gotta
for
see
himself.
He's got to see it.
Yeah.
Well, just go to Pub 590 and I'll tell you all about it. It's
Yeah.
issued by the IRS.
See, there you go. Well, look at that. A tax question, and you knew the answer.
I am not a tax advisor. I do not have a tax license. I'm not a CPA. Please do not take any of the things that I say and take it as a grain of salt. This is not an advice show. This is for your entertainment purposes only.
I think people already don't take us seriously anyway, so. All right. Is that it on that question?
Yeah.
Okay.
I don't know. He's a stickler.
He wants to know the code section.
So he...
I know a few code sections. If you want to sell real estate and defer the gain, rental real estate,
1031 exchange.
1031. If you want to sell a life insurance, if you want to get out of a life insurance product into another one, it's 1035 exchange without paying taxes.
Look at the big brain of Big Al.
Yeah. There's a couple code sections in there.
Yeah. All right. How about this one? I'm leaving my job with an employer-sponsored 401k plan. I want to roll over to a traditional IRA without cashing out anything. I have approximately $160,000 in the 401k. I already have a Roth IRA with about $17,000.
Okay.
What happens when I roll over my 401k? Can I still contribute to my Roth up to the $6,500 for the year? Or do I have to stop for the year due to adding the money into the new retirement account?
Okay, great question. I have to I go two different directions. One is if you take your 401k and you roll it into an IRA, well, there's no tax consequence. Of course, you can still make your Roth contribution if you have earned income, right? And you're below the income limitation rules, which what are they, Joe? If you're single, it's got to be below 113,000.
132,000.
113
Oh, yeah,
or 117 to 132.
Yes.
Is the phase-out period. Married, I think it's 186 to 196, if I'm not mistaken.
Yeah, it was 184, 194 last year. So.
Yeah, right. So, but the way he's asking it, it almost sounds like he wants to take his 401k and put it in a Roth IRA.
No, I didn't see that.
I did, as a possibility. And
I think you're just stretching this question out.
And I don't know that I'd do that, because now you're creating $160,000 of extra income over and above your salary for whatever the salary is that year. If you were to do that, though, interestingly enough, if you do a big Roth conversion, it doesn't count against you for those income limitation rules. That's right, where I wanted to go with that.
Got it.
Yep. And so, therefore, you made $100,000 of salary, you do a $160,000 Roth conversion, you're single, so your income is $260,000. But it doesn't count for purposes of that income limitation, so you can still do a Roth contribution.
Yeah, that's a great fact that I think a lot of people don't really know. So if you listen to this show by, I don't know, maybe once or twice, you probably heard us say something about a Roth conversion. Imagine that. And then we get calls and emails and saying, hey, you know what, Joe, Al, you guys don't know what the hell you're talking about. I did the Roth conversion, but I still want to contribute to my Roth. So I did, a $75,000 Roth conversion up to the top of my bracket. And so then I went to my CPA and I made the Roth contribution, and the CPA told me, hey, your income is too high.
Right.
So then I had to back out my Roth contribution. And I was like, no, fire your CPA. It's modified adjusted gross income. It's not included in your income if you do a Roth IRA conversion. It doesn't show up in the calculation to figure out if you qualify for the income limitations of your contributions. But what he was saying, in my opinion, was that, all right, I put $160,000 into an IRA. So can I still put money into a Roth IRA? Right? And the answer is yes.
Yeah, of course.
And, or this question comes about too. Is that, all right, well, here, let's say my taxable income as a married couple is $50,000. The recommendation might be to say, all right, well, you're in the 15% tax bracket. Convert $25,000 to get to the top of that bracket, which is roughly $75,000.
Yeah, for a married couple.
For a married couple. So you could convert $25,000. And, oh, by the way, you can still make a contribution. And they'll be like, no. Oh, what are you talking about? How can I get $25,000 into a Roth? I thought the limit was $5,500.
Right.
Well, yes, that's for a contribution. This is a conversion.
Different thing.
Totally confused. What do you mean? I thought it was $5,500. You're telling me I'm $25,000? Oh, how big a penalty will I have? There's no penalty. No penalty. No penalty. We're out of here today. Hopefully next week it's just not Big Al and I. We might have a guest. We'll see. So for Big Al Clopine, I'm Joe Anderson. Show's called Your Money, Your Wealth. We'll see you next week.
So, to recap today's show, emerging markets are the place to be if you want a high-octane portfolio and don't mind really high risk. Investing in things that actually matter to you may serve your portfolio better in the long term. Big Roth conversions don't count towards income limitations for Roth contributions, and Joe and I both hate Atlanta. Subscribe to the podcast at yourmoneyyourwealth.com through your favorite podcatcher or on iTunes, where you can also check out our ratings and reviews. And remember, this show is about you. If there's something you'd like to hear on Your Money, Your Wealth, just email info@purefinancial.com. Listen next week for more Your Money, Your Wealth presented by Pure Financial Advisors. For your free financial assessment, visit purefinancial.com. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision. Your Money, Your Wealth opening song Motown Gold by Carl James Pestka is licensed under a Creative Commons license.